I'm Justin Reid, CEO of Troilus Gold. We're developing the Troilus Gold asset in Northern Quebec. 8.1 million ounces, new resource out shortly, feasibility at the end of the year, 70% institutionally held, strong balance sheet, past producer, operated for 14 years, produced 2 million ounces of gold and 70,000 tons of copper.
Good to see you.
You too.
We're at the event of the North in sunny Quebec City. Well, as sunny as it gets here.
Sunny-ish.
Miserable. Big turnout. Wow, big turnout. Government, I think, sort of looking at critical minerals. Big turnout from some of your shareholders, the Quebec province, if big supporters of yours. What are you here to do?
I'm here to recover from the F1, like most of them. No, I'm joking. I'm here to really, it's a great opportunity at this event to catch up with the Quebec-centric shareholders. Yeah. So for us, this Investment Quebec, the case, Fonds Solitaire de Quebec, Sidex, St. James Bay, 6 of our top 10 largest shareholders are Quebec-based pension funds, and they're all here. Now, I spend a lot of time in the city and in Montreal, so I see them on a regular basis, but this is also the epicenter of Quebec government. So when we start talking about permitting and Plan Nord allocations and power allocations, everybody's in one place within about 3 blocks. And everybody's here. So it's a great place to get multiple groups in the room at the same time and figure out things that need to get done.
See, what I'm fascinated about your story is the strategy, okay? We've got some money, we're going to do some drilling, we'll let you know how that goes, okay? That is the extent of the storytelling. You've got a lot of moving parts. I guess government is a big part, and government support is a big part, and the money is a big part of what you are today. Okay, so that's good. You've got a lot of institutional guys and gals. You're sitting as a, let's call it $140 million company today. I asked you this on stage. We've been on stage already, working so hard today, where I said, right, how do you move that share price? How do you get regular guys and gals, not the institutional guys, not the 65-70% of institutional guys, how do you get people to recognize all of these bits which are moving in terms of the components of the environmental that you're moving forward? All of the studies that you've got to do, all of the other things that you are doing in the background, which people don't get noticed, don't get valued.
Yeah, and it's a great question. I battle it, I tell you the truth, because what I'm going to say the general shareholder understands is you're drilling, you spend lots of money, here's the resource. Now you're going to study that resource, and here's the feasibility. Right. And then when you have a feasibility, they kind of say, okay, what's next?
It's linear, right?
It's very linear. And for us, it's not, because we know we have a mine, and our shareholders are telling us we're not going to play that linear game with you. So what does that mean? That means that our detailed detailed project description, as step 1 of the permitting process is done, our EIA is underway. We're 7 months into permitting. Consultations are underway. And so that is, for me, it's a $5 million string, but it's a string. The EIA is a whole nother string. But with that, a lot of things that the market doesn't care about, but we do, condemnation drilling, which is, good question. Condemnation drilling is, I'm going to put my mill right here. So I need to drill out that whole area to make sure there's no gold there or copper there. I'm going to build an extension to the tailings over here, which we're not. We have to drill that out. Oh, I'm going to put the camp here. I have to drill that out. So our previous owners didn't do very good condemnation drilling because our pits are now going into the areas where the mill used to be. But that's a $3 million program. So all of those things require teams. And then of course we have the power and the power infrastructure. We have the biggest value we have besides our people and our resource is our talents. Hardest thing to permit. I would say it comes out of most scrutiny in the Court of Public Appeal. But we have this massive permitted tailings. With that, we have 45 pumps around it, and we have we have a whole team of technicians who are monitoring that on a daily basis. So just the upgrading of our infrastructure at site is a whole team in cost.
So right, and again, it says multiple streams advancing along various parts of what you need to do to build a mine. That's the key here. It's like, it's not a case that we need to flip this off to someone else's. That's their problem. I'm not going to waste money or budget. I'll do the stuff which gets the market to react. You were saying, actually, we've got cash. Finished talking about cash, shouldn't we?
Sure.
You just did a heck of a deal. Let's see.
Yeah, well, I mean, it was 8 months ago now, but it was the fact that we still have lots is a great deal. Again, as we started adding ounces, and we've talked about this on all the interviews, was we acquired 1,400 square kilometers of ground over a 2 or 3 year period. Spent $7 million exploring it, identified the main gold trend. Lots of opportunity in other parts of the belt. And Sayona had the mobile asset at the end of the belt, and they're saying, hey, we need ground to lay down our mine, build our mine, because they didn't have a lot of ground. And there's some exploration potential here that you're really not looking at. And so we cut a $50 million deal on 1,000 square kilometers, and it was a great deal.
5-0.
5-0. Yeah.
Okay.
And, as of our last financials, which came out last week, we're with cash and marketable securities and everything else, we have over 30 million left. And that is funding the company as we move forward. I'm excited that when we talk about the resource, our biggest burn is drilling, for sure. We've had...
But you said at the beginning, we got 8.1 million ounces. It's big enough, right? So what type of drilling are you doing that is going to inform the way that where you put everything, where you go first? Because managing cash, which you're going to have to do. I know you've got some, but it goes quickly, right?
Yeah.
If you need to go and raise, what are your options available to you? And the story you've got to tell is, we will get into production. We will get into production by X time frame, and here's how we're going to fund that. Like, people need to believe that you can do that.
Yeah. So let's go to the first part of that. X22, we believe, and the reason we made all these pivots, is a game changer for us. And discovery of all 550 meters to 5, we've had lots like that coming off of 87. Why this was important to us? Higher grade, certainly areas of it are a lot higher grade, and more importantly, low strip. The average strip for Troilus so far is about 3.5 to 1. This is going to be 1.5, 2 in parts to 1. Significantly better economics, better grade, better strip. You bring that production into your model early on. You expedite your repayment of capital, up goes your NAV, up goes your IR, easier to finance. Ultimately a better approach. That was all of our focus. That is winding up. And the moment that winds up, drilling stops, and as much as drilling costs, sampling costs. ALS, which is our lab, if you want your samples in 80 days, send it in. If you want them in 40 days, pay twice. If you want them in 20 days, pay 3 times. And so it's been a real big cost to get it done. But right now, everything is done on the drilling, with the exception of the last 2,000 meters. That's a couple weeks of work. All setting up for a resource in September feeds into feasibility. That has absolutely been our focus. And the moment that drilling stops, our burn reduces material.
So it's not a case that you were drilling in the wrong place. It's just you found something.
Well, we're not drilling
because it's the gaps.
Yeah, but we're not drilling it for an inferred.
Yeah.
We're drilling it to put into a bankable feasibility study, which means we need to get this to.
But what is it? You're kind of sitting with, you got the Southwest and and you've got
87.
Yeah. So you kind of like lower grade type stuff, and sitting in the middle is this.
Yeah, it's on another structure, and it is running significantly higher gold.
Yeah.
And shallow. In fact, we criticize ourselves for not finding it earlier because it's right next to the pit. But I guess
this is why you do big step outs, folks.
Well, I think we stepped out too far. We should have stepped out a little less. But we found Southwest, and that was the focus. So then all the focus goes to delivering the feasibility for the end of the year. And You know, we have 38 different engineering firms working with us on it. I think a lot of people don't understand the complexities that come with the feasibility, how many hands are on it. But we're in really good shape. And so...
you are, but not the share price.
No.
Not the market cap. You're in good shape answers. You're in good shape at getting higher grade. You're in good shape it's getting bigger. You're in good shape because your institutional shareholders understand, probably demanding of you, you play a certain way, you're advancing it forward, but there's massive disconnect, not just your company, lots of companies, just not getting the credit, value, understanding from retail or others. So what do they need to understand from you about why this is going to work?
Well, you know, I almost... They need to see continued de-risking and more communication like this. We have to deliver. It takes time to deliver these things.
So that's okay. Let's keep it simple, right? Let's keep it simple. Okay, to de-risk a company, you need to do what? It's in terms of where you are today, your advanced development play, right?
For us now, it is the resource, the feasibility, and the permit.
Right.
And everybody's going to say the exact same thing. But behind that, if we want to be in production at a reasonable time within majority of people's investment window, not 15 years from now, we have to do those multiple things, and that's what we're doing. To your point about what do retail shareholders need to see, we have great retail shareholders. How do we get new retail shareholders? Because, you know, retail shareholder A, you know, he might own $50,000 of stock or $20,000 of stock. He can't keep buying more and own more. He has his position. He runs a portfolio. Our institutions have their position in us. They have allocation of capital at various times when they think they'll need it. They'll allocate to the portfolio. So for us, it's where is that new marginal buyer? And that's the problem with our space right now. I think there isn't that marginal buyer. They were, and you said on stage, we battled Bitcoin. We're battling lithium right now, right? Sexy, fast, interesting.
Of the moment.
Of the moment.
So when the question was, you know, when does gold regain its crown?
Well, $2,000 gold. Every single producer in the world says, I'll take this all day long. For sure. Miko was up there, but produced 3.2, 3.1 million ounces, $800 cash cost.
But there's not a gig, right? I'm just talking about developers who need to get the same finance because you've got undervalued companies.
100%. So it's alternative financing now. The old days of, and when I say the old days, called the early 2000s, when I financed these companies, was, okay, your bankable feasibility's out, we need to raise $200 million. We didn't have inflation like we do today. Get us some project debt, maybe put a stream on it. Great, here's a $250 million piece of equity.
Yeah.
That doesn't exist. That $250 million doesn't exist. So where does it come from? Troilus, step one, we're back the Quebec institutions providing debt and alternative finance. You see a lot more partnering with the PE firms, the Appias, the Red Kites, the Orions, partnering with that. So more.
Let's talk about alternative. It's like debt, I get it, right? You and the EV metals, lots of debt whenever you need it, because where you're based. But the alternative financing, there's lots of ways you can come and play that. Some of it is terminal, quite frankly, if you're the wrong sort of company.
For sure. Predatory.
Predatory, right? Whereas, what does it mean in Quebec in terms of alternative financing? Well, with the lithium thing, remember there's NSR, which you could possibly sell it.
So we have a $20 million buyback. Right. You know, what's $20 million? It's working capital.
Right.
But all of a sudden, remember, we bought back our royalty from First Quantum in November of 2020.
How much that cost?
$21 million.
And people were frowning, going, "What the heck?"
They were. I still think it was next to the best deal we've ever done, because that was a 2.5% NSR. So moving forward, how do I limit that dilution or negate it, if you will? One, we're not a gold producer. We're a copper gold producer. We are going to be the largest copper producer in Quebec. So that 25 to 40 million pounds of copper a year, depending on where we are in the mine, goes into a concentrate, goes to smelters. You can put all different kinds of derivatives on the copper market. You can pre-sell to smelters. They can provide debt to guarantee offtake because these smelters can't shut down. They've got to keep going. Copper con is in severe demand right now, especially our copper con. It's going to be about 17% copper, but it's going to have 140 gram gold. So it's very high value con. That provides a huge amount of optionality to us. As well, we're going to produce between 500 and 1 million ounces of silver a year. Not a huge value, but if you think about a long-term stream on something we get no value, there are pieces that can fill in that gap. Then you talk about equipment finance associated with project. I think there's lots of ways to do it to limit. And ultimately, where do you bring in a partner? Right?
Well, that's the expectation, isn't it? For most people, that's going to go to, because right now, with advanced development stories like yours, not getting the valuation, it is expensive capital, not quite sure which levers are going to make the market react. And you know, with financing, not financing, with the money that you got in with Sayona, you didn't issue camel, it's diluted, but at the same time, you perhaps could have brought in different types of investors to the mix. 65-70% institutional is kind of restrictive in a way, is that it just makes it harder for people to buy, especially when the share price has been on a sort of downward trend recently. Right?
And the liquidity dries up as well.
Yeah,
and so
No,
you're right. And so a partner does a bunch of things. It brings another wallet.
What asset level are we talking about here? Potentially?
My job would be to preserve our equity, right? And so certainly, I think the best thing, maybe not the ultimate deal, but the best thing, if that was the scenario, would be to bring someone in at the asset level and say to the shareholders, whatever the NAV comes out at, our share count's fixed. Somebody else is going to pay for it. We can obviously take our approach and pro rata share the debt or what have you, but you have to buy in. And ultimately, that could be a huge one. Yeah, I guarantee under any math that's accretive, because I have not seen a mine funded and built where there hasn't been, they need $200 million. And it's very different today, as you pointed out, compared to the old days. When a Cisco and Detour were financing, they raised at 50 cents a dollar, $2.50, $3.70. They had a market behind them.
Yeah.
And now everybody's financing at $2, $1. Some it's going the wrong way, and the dilution adds up. So it's about finding alternative financing to try and protect your shareholder value as best you can.
Right. But do you think that your strategy of 2022 and this year as well with the drilling, you're spending money on drilling, it makes sense to do that because no one's getting, in fact, most companies are veering away from economic studies because with the whole inflation issue, supply chain issue, driving costs and prices to the roof, and the economics just didn't stack up. And even the most naive of retail investors could see, well, that isn't going to work at these levels. And so, look, companies got punished for that. So you avoided that, but now you think you're timing it right for the end of this year?
Yeah, no, I do, because one, we have to deliver. Our shareholders have been really patient, and X22 makes a huge difference. It was absolutely the right thing. My board and I don't regret that decision at all. That was the right decision to make, just like buying back the royalty, just like selling Sayona, and it's going to make a good deposit grade. And so for us, we had to keep drilling that zone out because that's where the mine is going to start, and the impact will be seen. Certainly, it's being seen in the drill results that are coming out. But you're right, huge burn. That's coming to an end.
Yeah, we've seen a lot of cash generated by producers. They're the beneficiary. It kind of feels like the gap between producers and developers has increased because of market conditions. Without question. So they're kind of in control of those conversations. You're trying to make sure in your case that they're less in control, but nevertheless, they are out looking at M&A activity. They are looking for targets. And for the first time in a long time, first time in many cycles, they're not buying at the peak because the values suck. Whatever they're looking at, it seems cheap for them at the moment. Do you ever see a scenario where a major comes into Quebec and said, look, there's probably 2 or 3 companies in your perceived position. Let's just snap all those things up. They're all sub $200 million, and crikey, we got the answers. We could consolidate. There'll be efficiencies.
I think it is not crazy at all. And if I was the government, who are, you know, to the laundry list of companies every year saying, oh, 2 million for you, 2 million, you know what I mean?
Yeah.
Would say, Matt, we would just like to write one check to the Quebec developer in the gold space.
Yeah.
Now, is it a major who does it?
Yeah.
Is it a Newmont, a Barrick? Is it Agnico in their backyard? Maybe. Or is it a mid-tier junior that just says, you know what, let's get everybody in the room, check egos and say we're going to make it ourselves and the sum of the parts.
Yeah.
But that's far harder. I think that a major or a mid-tier looking for a foothold and a pipeline, and that's the biggest negative to majors and mid-tiers now fall down is replacement of houses. We've talked about that before. That would be the best way to do it.
Yeah, because we've been speaking to first time managers looking at from outside in going, all sorts of metals stuff you seem excited about. Well, it's cheap, it's needed, there's a market for it, it's all kind of good. Well, who would you invest at? I wouldn't invest in any one company. Because they think they had a CEO say to me, well, maybe we should just merge with X company. They're kind of like us. We'll get some efficiencies there. And I'm like, you're looking too small. They're big funds looking into the space going, how do I deploy 500 million? How do I deploy $1 billion? How do I deploy $2 billion? That's the trouble with mining. It kind of feels like it's kind of small beer, small thinking.
Well, and what is it? The entire market cap combined in the gold space is half of Apple or something.
It's all mining. It's from BHP down to all six where you combine that in one entity, it's 50% the size of Apple, or less these days, which is one technology company. That's what we're dealing with, the mentality here.
Yeah.
It should be more, but it's not. Look, Justin, you are cracking on. Strategy seems to be working, the money seems to be flowing, and I think the markets to recover.
Thank you.